Well, as high inflation has pushed up wages, the cost of labor has risen in Canada and around the world. But the latest data suggests that while the per unit cost of labor in the United States is starting to fall, that isn't the case in Canada. And that is impacting productivity on both sides of the border. And it could be making Canadian inflation even worse. To explain what it all means, I'm joined by Benjamin Tal, Deputy Chief Economist at CIBC. Benjamin, thanks so much for joining us this afternoon.
Thank you. It's a pleasure.
So before we get too deep into the unit cost for labor, tell us what it is that even means.
Yes, you know what? It's basically telling you how much it costs you as an employer to employ somebody. It's not just the wage, but it's a wage relative to productivity. Because if I pay you 10% more and you're 10% more productive, that's not inflationary as far as I'm concerned, because I get the return from you vis-a-vis productivity. So unit labor cost is basically the cost of unit after you adjust the pay to the increase in productivity. So when it goes down, it means that actually it's a good thing because it's costing the company less because the workers are more productive relative to the wage and vice versa. And we see in the US, it's actually slowing down dramatically, while in Canada, it's rising rapidly, suggesting that something is wrong here. It's either wages or productivity. And of course, the situation in Canada is productivity. Our productivity is negative. In the US, the productivity is relatively strong, and that's why unit labor cost is going down.
Yeah, we've got a graph of yours. It's looking at the US, and it's comparing productivity with job quality. So can you tell us a little bit about what we're looking at here? The job quality line for us is the blue line, and it's going down at the end there, and the white line is productivity.
Yes, so one of the reasons why productivity can go up is because of the fact that there is an improvement in the quality of employment. Namely, you have a higher share of high quality employees, and therefore productivity as a whole is going up. That was the case until recently. As you can see from the chart, over the past few months, quarters, the quality of employment in the US is starting to go down. Namely, the people that are being hired at the margin are low wage, low quality, and therefore low productivity. And if you look very close at this chart, you can see that quality of employment is leading productivity. This means that if I'm right, over the next 6 months, productivity in the US will start slowing down. And that's something that will put some upward pressure or upward risk on inflation, because inflation is protected by productivity. Productivity is the best protector of inflation. And if you don't have productivity rising, inflation is a problem.
So why do you think that shift is happening in the US now?
This is a typical behavior at the last stage of the cycle, namely when the employment starting to slow down, you see the quality of employment going down. And that's something that led to the decline in the productivity, or will lead to the decline in productivity. You see, we have to remember that during COVID, all of a sudden productivity in the Canadian economy and the US went up, as you can see from the chart. But it wasn't because we were more productive. It's simply because of the fact that most of the people that were let go were low quality, low wage individuals. So the pool that left was actually high quality, high productivity, and then it went down when the market normalized. That's part of the normalization process of the market.
So if Canada is also at this stage of the cycle where, the gains might be more of the low quality jobs, or does that mean that the productivity issue that we've already been facing for quarters and quarters now, Benjamin, could get worse in Canada?
I really don't want to think this way, but yes, that worries me, because at this stage of the cycle, the quality of employment will determine the direction of productivity growth, and I think it will be south. Now, we have to remember, as we discussed in the past, eventually this lack of productivity must lead to something. Profitability in US and Canada is starting to go down. Profit margins are starting to go down. Companies will have to do something about it. This something will be to replace labor with capital, which is the very definition of increased productivity. And that's why I'm actually excited about the fact that over the next 5-6 years, I believe that we are going to see a wave of investment in corporate Canada that will lead to improved productivity, as we have seen in the 90s.
Well, that would be huge.
That will be wonderful. We need that. You see, profit has been relatively easy for the past 20 to 30 years. So there was no motivation to invest and increase productivity because profit was easy. Profit now is not easy. Deglobalization, just-in-case inventories, a tight labor market means that profit margins will be under constant pressure. You need to do something, and this something will be investment. So in the past, it was just nice to have. Now it's a necessity.